This is the Real Estate Foundation, your show for massive action with proven results. Raise your life and your legacy with real estate.
If you're not using retirement funds to invest in real estate, you're leaving capital on the table. With a self-directed IRA from Advanta IRA, retirement funds can be used to invest in rental properties, rehab projects, private loans, multifamily syndications, and much more. Advanta's IRA's dedicated one-on-one account managers make the investing process fast, easy, and reliable for you and your investors. Plus, if you're self-employed, Advanta IRA offers a low-cost QRP or solo 401k plan so you can maximize retirement savings, invest in real estate, and avoid UBIT tax. If you're raising capital or have a network of passive investors, Advanta IRA can help you unlock the trillions of dollars that sit in retirement accounts. Whether it's that fixer-upper down the street or a large multifamily property, make sure you or your investors never miss out on another investment opportunity. Go to advantaira.com/REI today to learn more. That's advantaira.com/REI. Hello again, and welcome to another edition of the Real Estate Investing Foundation podcast with Jason and Peely. You are stuck with Jason today, but you are in good hands because we have an awesome guest for you, Brian Burke. Hey, Brian, how you doing?
Hey, I'm doing great. How you doing?
I'm doing great. And Brian Burke is the president, CEO of Praxis Capital Inc., a vertically integrated real estate private equity investment firm. Praxis operates on multifamily platforms, currently managing active syndications for the acquisition of multifamily, single-family, and opportunistic residential assets in U.S. growth markets. Brian's acquired over $400 million in real estate over a 30-year real estate investment career, including over 2,500 multifamily units and more than 700 single-family homes with the assistance of proprietary software that he wrote himself. Brian has subdivided land, built homes, and constructed self-storage, but he really prefers to reposition existing properties. So, I mean, we got a lot we can unbundle there, but let's take it back. Where was the point that you said, all right, this real estate thing, I like it. I'm gonna really move with this real estate thing.
Yeah, when I first started, it was kind of on a whim, and I was like 20-something years old. I didn't know what I was doing. So, then it was it was more of just what I thought would be a cool idea, and then it took about I'd say 8 years before I really decided that it was really something I should spend some time and focus on. So I really did, about 8 years in, I started focusing on it. That would have been around 1997 or so, I guess. And then, spent about 3 years really building the business. And, about 3 or 4 years later, I was able to quit my job and focus on it full time. And that was like around 2001 and never looked back. So we're going on about 18 years now of doing nothing but real estate.
Oh, I love it. I love it. And you've done so much over, the 18 years. When you took that step out from the job, what was the first, we'll say, space of real estate that you were really diving into?
At first it was all single family fix and flip, buy a house, fix it up and resell it and make profit. That was really the bread and butter of this business, all the way until around 2003 or 4, when the market was so overheated that even that strategy started to make a lot less sense. Took a couple of years kind of pulling back because there was really nothing that, really was looking good enough to buy. And then the market completely collapsed. That changed everything. It was time to dive right back in full speed and, immediately started flipping about 100 houses a year.
Wow.
And built a pretty incredible business doing that for a while.
So with 18 plus years in this, you've seen a lot of different market dynamics. What has been something of a success strategy you use to implement to really have the sustainability?
Well, I just look at real estate investment as a landscape of a meandering stream in a meadow, right? And the stream kind of curves left and it curves right. The current will speed up and slow down. And, the only thing I can guarantee is that if you row in a straight line, you'll run aground. So what you have to do is you have to be able to steer. And, when the stream moves right, you move right. When it moves left, you move left. When it speeds up, you enjoy the ride. When it slows down, you're real careful. And if you can kind of employ that and, and alter your business strategy to conform to what the market is telling you should be doing, you can survive in any market.
When you were talking first about how when you first started in real estate, you spent 3 or 4 years basically building your business. That usually comes later. Was that a natural approach? You said, okay, I got to focus on the business first, where so many people fall into that trap of just really getting out there and trying to do it and then realizing that it's not really a business?
Yeah, I already had spent 8 years doing that by the time I spent my 4 years, really trying to build the business. It's like spent 8 years kind of floundering around, and then you're like, how am I really going to systematize this and make a business out of it? And that's when I spent an inordinate amount of time just doing like writing software and developing systems and, really figuring out what my strategy was going to be. And then, in that 4 years, I built it into a business, and it turned into one that has never looked back.
And so you moved from single family and you really jumped large into multifamily today. What was that? Was that market driven, or was that just tired of dealing with so many houses spread over so many areas? What was the dynamics? You said, okay, enough's enough.
Yeah, it was twofold. I mean, it way early on, about 19 years ago, in fact, I made my first multifamily investment, and it was just kind of a wealth building strategy, right? You do a 1031 exchange out of a couple of houses, you buy an apartment building instead, and you're getting some scale. And at the time, I was just looking for scale. What I didn't realize is that it was going to scale the way it did, and the catalyst for that, which is kind of a second aha moment, was in the midst of all this chaos. When the market turned down, we were raising an incredible amount of capital to do our single family business, but at the same time we knew that it was a real short-lived business plan, right? I mean, there's only going to be foreclosures in this quantity for so long, and then what are we going to do? We've got all these investors, and what next? And multifamily is really a scalable and sustainable business, and it also is very capital intensive business. So we found that the two actually fit really well together. And if we really focused our strategy on multifamily, we had the investor base to get it started, and that's exactly what happened. And it started with one, and then it was two, and then it was a lot more.
Yeah, it's awesome. And so with everything that's happened, talk to us a little bit about how your business looks today.
Well, today, we're, over 2,500 units. We've raised over $100 million from investors, the hard way, a few dollars at a time. And, we're growing rapidly. We'll have closed on the acquisition of about 1,000 units in the last 12 months. We currently have about 700 units in contract to acquire. And, it's moving, and we'll probably do even more next year.
I love this. And so there's a couple different ways we can go, but I want to touch on the 100 million raised the hard way. So you look back at that, right? And so you've done it. So with that said, when you look back on that, what lessons or what key points could you give for people that are maybe looking how to get out there and raise their first amount, or they've done smaller raise and they're looking to really scale up their raise potential?
Man, there's so many pieces of advice in that. That's a real loaded question, because it depends so much on what someone's position is. If you're looking to raise your first few dollars and, and you're kind of stumbling and, not getting a lot of traction, you're probably fishing in the wrong pond. You really have to go to people who already trust you for some other reason. Someone can't invest with you because of your extensive real estate track record if you don't have one. Yeah. They'll only invest with you because they already trust you for some other reason, because you're a blood relative, or you're their lifelong best friend, or they've known you for years at the Rotary Club, whatever the heck it is. That's really your pond to get you started. And don't worry about how small the deal is. I mean, it might be where you're, the first fund I raised it from my coworkers. My minimum investment was $5,000. And, that was literally, it got me started. And without having done that, I would absolutely not be where I am now.
Yeah, and that's awesome points, right? And it's exactly right. If you don't have the experience, but you have to find the experience where you can put out the experience somewhere else with the group who knows you. Yeah, key points right there. And you got 1,000 units that you've closed on the last 12 months. You got 700 in the pipeline here. You hear so many stories. People are running for the hills right now. They're turning the other way. Oh, something's going to happen. We've been hearing it for 3 years now, and you're all in right now, pushing forward. How are you finding investments that you feel are the right fit for your metrics, and of course being cognizant of where we are in the market cycle?
Well, there's two things. One is I look in areas where I feel there's resiliency. So, I want to be in a market that has population growth, job growth, and income growth. If I have all three of those pieces even an economic blip, recession, downturn, whatever you want to call it, will have a different scale of impact than it would on a community that's already hurting and suffering. So I look at not just the economic cycle, I look at a demographic cycle. I want to see an area that has demographic growth. And if I can see that, I can hedge myself. And then, so that's kind of the market selection side. And then, the asset side is it really just comes down to sourcing opportunities directly off market from sellers and through brokers. And really most of it comes through our broker relationships. And, we've positioned ourselves to be very easy to work with. And we're closers. We don't screw around. We don't retrade. And word gets around in the brokerage community and they like their job to be easy and they want to bring their best deals to buyers that they are confident will execute without giving them a lot of problems. And that's us.
I love it. And for Praxis Capital, is there a key business philosophy that you take with these assets? Are you doing, heavy value adds? Is there that secret sauce that you put into your properties that is a repetitive process for you?
Yeah, we have essentially a formula on our renovations. They all look very similar to one another. We use similar finishings from one property to the next.
Is that the single family flipping business, putting that into motion?
It's exactly where it comes from. Yeah, it's exactly where it comes from. And we're doing the same thing. We're flipping apartments instead of flipping houses. But the flip isn't a sale. The flip is a rental, right? So you're taking a lower valued rental, you're flipping it and renting it at a higher price. It's the same exact concept. It's just doing it at a larger scale and just, in a little bit different way.
Yeah. And that's sweet. Even thinking like on that concept, right? And even talking to that from that note, right? You are really just flipping the units just on a larger, grander scale, and it gives you the economies of scale. From your perspective, where are you pushing now with these next units coming online? Are you staying in our markets? Are you moving across various markets? And maybe I'll even ask the first question. Are you heavily centralized in one market or spread in many different areas you feel have opportunity?
We're a little bit of both. We're spread in areas that we feel have a lot of opportunity. However, we've found, a high degree of success in some areas more so than we have in others. And, part of that is relationships. Part of that is just the quantity of product, it's like Salt Lake City is a great market, right? But it's like there's so little multifamily product there that you don't have a high degree of transaction volume. So no one's going to go in there and in a couple of years accumulate several thousand units. It's just not that easy to have that happen. But we did that in Atlanta. We've acquired, I think, almost 1,800 units in Atlanta in, about 18 months. So, that was, there's a lot of multifamily units in Atlanta though. So, there's a lot to choose from. But we're looking at, Arizona, Texas, Georgia, Florida, Carolinas, Nashville, all those kinds of markets. Really strong population growth, job growth, and income growth.
So from a property side, or we'll say on an underwriting level, what are some of the key metrics that are very important for you guys to greenlight a project?
Well, probably the most important is lift. How much rent lift can we get? And this comes back, this is a little bit of an interesting way of thinking about it. A lot of people want to think about cap rate and this and that and whatever. Yeah. But this comes, it drives back to my history of flipping homes, because when you're going to buy a house with the intent of reselling it, what you want to know is how much more can you sell it for over what you bought it for. And so this is kind of the same concept in multifamily. How much more can you rent it for than what it's currently being rented for? And if there's a wide enough delta there, then the returns are going to take care of themselves in most cases, as long as you buy it for the right price. So it's a little bit about rent lift. I use a formula that I kind of think I invented myself and named it myself, called development lift, and it's kind of a complicated formula, but ultimately at the end of the day, what you're calculating is what's the stabilized value over the acquisition value, and what's the delta between those two numbers. And if you can get a 20% lift in value upon stabilization, which is usually in 3 to 4 years, you're going to do pretty well. And so, really what it bakes down to is an IRR, a cash on cash return, and an equity multiple. But again, those take care of themselves as long as you can add enough value.
And so this developmental lift, is that your, I guess, your transition of an ARV from single family homes into multifamily product? Is that a similar, not of course, it's of course I'm sure more complicated, but is that the same thought process going in there?
In a sense, yes. It's really about establishing an ARV and determining the delta between that ARV and your going in price. That's the formula isn't exactly calculated that way. It's calculated differently, but ultimately that's the end result. That's what you're measuring. You're measuring how much lift you're getting out of the money you're putting in the property.
Got it. And with so much happening, and you're bringing on 1,800 units the last 18 months in Atlanta, just what we talked about before. What does your team look like? What are the key components of your team to allow you to scale to this capacity?
So we got kind of two branches of our team. So we have we have like the acquisitions, dispositions, and capital branch, and then we have the operations branch, and they're two kind of separate, completely separate branches of the same tree. So on the acquisitions, capital, and dispositions branch, it's a relatively small team. I've got myself, I've got a chief investment officer, I have a CFO, I have a senior vice president of investor relations. So in those roles, we've got someone out there, looking for real estate, someone out there helping to evaluate that real estate, someone out there to talk to investors to help raise capital. I've got an analyst that builds the models with the rent rolls and T12s and that sort of stuff, and that's really all we need. And that team will carry us to probably close to 10,000 units without having to add any headcount. On the other hand, we have the operations team, which we're vertically integrated, so we have our own property management company. So under that arm, I have a CEO in charge of my management company. He's got a chief operating officer that assists him, as well as a regional manager, a corporate controller, an accounting team, and then you've got an entire army of site staff. So I think right now we're over 50 employees on that side of the operation, and as our unit count grows, the head count will also grow as well.
Yeah, and that's sick. So I'm sure I know this answer, but I'm going to ask the question anyway. Did you put the team together with the anticipation of growing out, or have you added as you've scaled?
A little bit of both. It's 30 years in the making, and I think we were at about year 27 when we really built out and had the whole thing dialed in. So, about the last 3 years is when we really started to kick it into overdrive. And, the way this happened is I got, just by stroke of luck, I had a guy that I knew, or I didn't know, but we had a mutual connection, and we got introduced, and he had two colleagues of his. So the three of them were all in the institutional world as competitors, working for various big name firms that, a lot of your listeners have probably heard of, the real big guys, with tens and tens of thousands of units. These three guys had 100,000 units of multifamily experience between the three of them. And, they joined up with Praxis 3 years ago and helped build out this whole infrastructure. One of them is the CEO of our management company. One is our CIO, and the other is our CFO. And so now we built the mousetrap, and then what we had to do was set it in motion. And, that meant, starting to buy properties and add them into the portfolio. And, we began doing that and kind of grew the rest of the headcount on the operational side as we grew.
And the need or the want to have in-house property management, was that something that happened based on design, or was it just by necessity?
It's both. It's really design, and it's a specific intent. And what I mean by that is there's on the design aspect, we get better control over the entire process if we have it all in-house. We have better integrated accounting if we have it all in-house. We're all under one system. All the properties are interconnected with one another, on a IT level. So, we've got robust institutional grade infrastructure for accounting and property management. But at the same time, there was also, this other element, which is that we're seeking institutional capital partners to help fund our acquisitions. And institutional capital partners have come to recognize over the years that groups that manage their own assets tend to perform better, and therefore they have a preference towards funding groups that are vertically integrated. In anticipation of seeking that capital, we got ahead of it and vertically integrated early on.
Huh. I did not know that point. That's a great point right there, right? Especially if you're going to scale that capacity, and that's where your in run is to be set up. But it does give you the control, right? Usually, the property management company, if you're using third-party management, I mean, that's your face. They have to implement your plan, and either they give you good guidance that they can or they can, or they just ultimately cannot do your plan, and then you're stuck either dealing with that or having to just go to another source so hopefully they can implement the plan correctly. So having it in-house, how do you deal with being in so many different markets? Well, I guess let me take that question back. How do you deal with when you do move into a new market, just setting up those systems with that in-house property management company?
Well, that's the nice part for me, is by having an expert in charge of our operations team. I don't have to worry about that. That's his problem. But the good news for me is that he's done this before, and this is the 6th time he's set up national multifamily management footprints.
Wow.
For various institutional groups. Most recently, I'm sure you've probably heard of Grubb & Ellis. He was the president of their multifamily management company. In fact, he founded it and took that national. That's the kind of skill and experience that we needed to be able to build that out. So you got to have somebody that's been there and done that and already has worked the kinks out. So we've got the systems already in place. We set the corporate culture. We handpick the teams, and we have the network to do it from.
Yeah, and I love that. And with your growth that you're looking to expand into in the next 12 months, how are you using, of course, the interest rate environment to your favor?
Well, actually kind of recently, it hasn't been working to our favor. Spreads have been up about 30 or 40 basis points in the last 2 weeks. So, interest rates are an interesting moving target, but our modeling tools are very sophisticated. So, we're able to model to any number of capital stack design. We can model to fixed rate debt. We can model to adjustable rate debt. We have forecasts going out 10 years for LIBOR on a monthly basis that we get from Bloomberg, so that we're able to say, okay, if we got a floating rate debt, what exactly would we expect, that debt service to look like? And we model out various debt scenarios, and if interest rates go up, it just simply changes the output in the model. And if we're trying to solve for the same return, it means you lower your price. So everything is just a function of solving for a return, and interest rates are just one of those variables.
When you're considering, and I guess the first question would be, is there a standard hold period or a standard procedure for the length of time you're looking to hold these properties?
I wouldn't say there's a standard. I came from the world of flipping, right? The first thing I did in real estate was I flipped real estate. The next thing I did in real estate is I set up a buy and hold fund, and we started buying single family homes and holding them as rentals. So for my whole career, it's always been like, are you a buy and flip guy or a buy and hold guy?
Got it.
And, for multifamily, I'm neither. In multifamily, I've coined the term that I'm a buy and watch investor. And what I do is I buy the asset, I fix it up, and then I watch the market for the optimal time to exit. And that might be as soon as I finish my value add improvements. It might be 5 years from now. If there's an adverse market cycle, it might be 10 years from now before we can sell and achieve the results that we're looking to achieve. So really, it's just the market will dictate to us when it's time to leave. And we'll listen to those cues, and we'll do what the market says. Having said that, generally we've found that the best time to exit is usually around year 3, somewhere between year 3 and year 5, right after we've completed our value add improvements. And again, if you think about like the hockey stick of on a graph of rental income, and if you increase it really rapidly in the beginning because you've improved the real estate, but after that, there's an inflection point where the market, where the business plan shifts from something that you're doing to something that the market is doing for you. And when we reach that inflection point, usually to me, it's time to get out. We've done what we can do. I don't want to leave the rest of it up to the market. Let's get out and let somebody else worry about that. So usually that 3, 4, 5 year point.
And when you're looking at your exit, do you have any good strategies? And I'm not even sure if you're looking at it this way, but for determining where you're going to stand on an exit cap?
Well, when you're selling, it's pretty easy. You can look and see what the comps are doing. What cap rates or properties seem to be trading at that time. But to forecast an exit cap up in the beginning is a little bit art and a little bit science.
Yeah.
And what we do is we use a starting rate of where are cap rates today? What would be an exit cap rate of a stabilized asset today? And then we look at what do we think is going to happen to cap rates in the future. Now, our opinion is cap rates are going to move upward. How soon and how fast, nobody really knows. We tend to use 0.1% a year. So if we're selling in year 5, our exit cap's 0.5% higher than our forecasted, day 1 exit cap. And if it's 10 years, it's a full percentage point. But sometimes we alter that too. I mean, there's reasons why you think that you might have a compressed cap rate on exit because there's a specific value add play. Like let's say you're coming out of a low income property that can roll to market rate, for example. Or you think that there's a reason why cap rates might deflate greater than that rate because, you think that the market may become less desirable or something in that area as time goes on.
Yeah. And that's just great feedback right there. Right. So, and I like the term, how you said it's part art and part science, because there's no steadfast rule, because I hear some rules kicked around, but ideally you just have to identify so many different factors that could be happening. And I think the low income tax credit example is super, right? If you have that to your advantage, well, that's going to be a viable resource why someone's going to want to pay you more for the product. So looking at your time and your day, you've accomplished so much. You're still, you're in year 30 with the huge team that's built around you. How are you being able to be most productive in your day?
Well, I guess I don't have to be all that productive. I've got a great team, and everybody's working really hard, and we're all accomplishing what needs to be accomplished. So, I think a lot of my productivity comes from efficiency. We use technology pretty heavily. I live literally like 4 minutes from my office, so I don't have a long commute. It's all by design. I try to be very efficient. I don't spend a lot of time traveling around. My chief investment officer is out looking at real estate. I'm in here in the office crunching numbers and kind of orchestrating the whole thing. So it's just really about using technology to your advantage and being very efficient with your time, coupled with the fact that my day usually ends about 11 p.m.
Got it. I got it. Well, I'd say, we've had a couple hundred episodes, and it's probably our best answer yet. I don't have to be, because I've built a team, right? And that's what everybody's trying to do here, is be efficient by building a team around them that can handle it. And you come in and tackle the important things when you can tackle them and when you need to tackle them. So kudos to you. Is there an end game, or is there, where does Praxis Capital go? And where is the ultimate vision for the company?
Well, who knows? Our kind of soft target goal right now is to hit 10,000 units. I expect we'll get there. I wouldn't be shocked if sometime we aren't talking about 20,000 or 25,000 units. But, I was just having a conversation the other day with my CFO, and, he was recalling back to a time when, he knew this other group. They were about a 5,000 unit local operator, and he's like, gosh, those guys, they're now on 200,000 units. And, and he's like, they never saw it coming. It's just like one thing led to another, and, who knows where this will go. I plan to be here for a little while longer. I've been doing it for 30 years, but I'm not done yet. So we'll see where it goes. We'll see what the market allows us to do.
Yeah, that's awesome. And you have some words you live by, or a company motto or slogan?
Nah.
Good. Like that too. I like that too.
I don't need mottos and slogans. It's like what we want to do is we want to be really good real estate operators. We want to make smart decisions and make good buys, and not spend too much time fooling around with figuring out what kind of slogan we want to have.
I love it. Well, we'll take it to this. Is there something that stands out as a key learning lesson you've learned? Let's just say in multifamily, since you've been in the multifamily arena, going to a large capacity, is there a learning lesson that's really stood out to you that you could share with the listeners?
probably that the world is bigger than you. It's like, people think that, they can manipulate the market or control the market or outsmart the market. And when things aren't going well in the world at large, things aren't going to go well in your multifamily business either. So, underwrite conservatively, plan for downsides, stress test your numbers, run sensitivity analysis, figure out what the worst case scenario is. Stop being so positive about how great the market is and how great real estate is, and buying with what I call irrational exuberance. You are not a kid in a candy store. You're just a participant in the climate that you're investing in. And you got to make sure that you've accounted for all of those things so that you can enjoy the ride rather than getting slammed by the fall.
Yeah, I love that. And if there's a new investor who's looking to start into multifamily, is there a key, I guess, a key piece of advice that you could offer to them for them to start their journey?
Yeah, don't worry about how small you start. You don't be thinking that your first deal has to be 100 units. If your first deal is a single family home or a duplex, that's okay. You're building a track record. Buying something is better than buying nothing, assuming that it's a good enough deal, obviously. But don't get hung up in the go big or go home rumblings that you hear out there in guru land.
I love that. Well, Brian, thanks so much for coming on the show. It's been a ton of value for everyone here. Really appreciate your time. For everybody who wants to find more about you, find more about Praxis Capital, what's the best way to connect?
The best way is probably through our website, which is praxcap.com. It's praxcap.com. I also participate pretty heavily in the biggerpockets.com forums. So a lot of people either know me from there or have seen me around or whatnot. So, love to answer questions there too, on questions surrounding multifamily and syndication.
Yep. Just nothing on company mottos. That's it.
That's it. Yeah. I'm not much help for you there.
Good.
Can't add any value for you. Sorry.
Brian, this has been awesome. Thanks so much for coming on the show. We really appreciate your time.
Thanks for having me. Had a lot of fun being here.
Awesome. Well, this is Jason with the Real Estate Investing Foundation podcast. Huge thank you to Brian Burke. Huge thank you to you, all of you listening out there. Have a great day. Bye now. If you're not using retirement funds to invest in real estate, you're leaving capital on the table. With a self-directed IRA from Advanta IRA, retirement funds can be used to invest in rental properties, rehab projects, private loans, multifamily syndications, and much more. Advanta's IRA's dedicated one-on-one account managers make the investing process fast, easy, and reliable for you and your investors. Plus, if you're self-employed, Advanta IRA offers a low-cost QRP or solo 401k plan so you can maximize retirement savings, invest in real estate, and avoid UBIT tax. If you're raising capital or have a network of passive investors, Advanta IRA can help you unlock the trillions of dollars that sit in retirement accounts. Whether it's that fixer-upper down the street or a large multifamily property, make sure you or your investors never miss out on another investment opportunity. Go to advantaira.com/REI today to learn more. That's advantaira.com/REI.